Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time November 2022. So it's this time of the year where we're trying to look forward and see what we can expect from the next year, from 2023. So today I want to zoom out and take a look at the big picture, what's going on with the economy, with inflation, what's happening with recession concerns, and how all of that is impacting the real estate market. So big picture stuff today. But before we get there, let's take a quick look at the latest numbers from the MLS. So first of all, we have here inventory that is down again. We were very low on inventory previously. A lot of people have expected inventory to go up as the market is softening. That is not happening. It goes the other way. We're seeing shrinking inventory. You can see here minus 3.9%. And just for some comparison, in October 2015, which was the last normal neutral balanced market that we had almost 13,000 units on the Milwaukee market. So you can see how low inventory actually really is. The real surprise here is with homes sold. So that is down minus 28%. And that is really showing how the marketplace is contracting, because we're not losing only buyers that have hit the pause button because it's that time of the year. Everybody's getting ready for holiday season. But of course, it's also the 7.5% mortgage rates that have spooked a lot of buyers and said, well, we're going to wait because our cost of housing has gone up so much. We will see what happens. So this is the combination. But we also see sellers withdrawing from the market, because most sellers are also buyers. And not only will they have to pay more for their bigger house that they're usually buying, but they also have to walk away from a 3% rate mortgage and buy into a 7.5%. Or at least that was the situation in October. We'll talk about mortgage rates in just a second. So sellers and buyers are withdrawing from the market. So the whole marketplace is shrinking. And less units are being sold. The speed on the market, velocity in the market, still very, very high. In the summer we were at 5 days median. Now we're at 10. That is still very fast compared to a neutral market, about 50, 60 days on the market. And we had a couple listings the last weeks that sold very quickly with multiple offers, and that is still not totally the exception. We still see that a good listing will have 1 or 2 or 3 offers right on the first weekend, and it might still go over asking price, although the market is not as hot as it used to be this year in spring. So we're cooled down a lot compared to where we were. So what is that doing with pricing? 280,000 was the median price. That is still up 7.7% compared to October last year. So you may hear people talking about how real estate prices are coming down. What they are talking about is month over month. So compared to June, July, and August, of course, prices are down now. But if you're comparing it, which is the correct way because of seasonality, if you're comparing it to October last year, the same time last year, we are still ahead 7.7%. The Milwaukee market is also developing stronger than the national average. That is very important to notice, and we'll talk about that in a minute as well. But first of all, we had big news on Thursday coming out. We have new inflation data. The consumer price index dropped and actually came out at 7.7%. So you can see we're developing here somewhat of a peak. It's too early to tell. Could it be a false peak? 1 month doesn't really make a trend, so we will have to keep watching that. But that was really, really good news from the inflation side, and that had an immediate impact on the stock market. You may have seen it on the news. The Dow rallied. So stock markets did really well that day. And of course, we have also seen mortgage rates coming down. And I've always been speaking here on my market updates about how the inflation and how the policy of the Fed is driving the mortgage rates. And here you can see it actually in action. So the same day that the consumer price index came out, mortgage rates dropped here from 7.37% to 6.62% in one day. That was the single biggest drop, I believe, in 50 years that we've seen on mortgage rates. So you can see how that is all tied together, and how inflation and Fed policy are impacting mortgage rates. So this is happening, and that's the reason why we have to keep an eye on what's going on with inflation, because that is going to drive Fed policy, and that is going to drive mortgage rates, and that is going to drive the real estate market. So our outlook on the spring market really hinges on that mechanism and how it pans out. Now, I want to talk a little bit more about home prices in the US and how Milwaukee is performing relative to the rest of the market. So what I have here is the sale to list ratio. And I just want to take here Seattle as a As an example, you can see that we're in early spring here, there were over 110% sale to list ratio. That means on average, buyers were paying more than 10% than list price. And that ratio, of course, this is a very hot market. That ratio came down. Now they're below 100%. Austin, Texas is another example of a market that flew really high in spring and that coming down now with a lot of buyers being able to negotiate a discount from list price. That is what that ratio means when it falls below the 100% line. Milwaukee here in that turquoise color, you can see we were never that hot. We had our peak in June, a very strong summer with people paying over asking price. But we are not coming down here. We are still just a little bit over 100% sale to list ratio. So the Milwaukee market is holding out a lot stronger than a lot of the other markets that we have in the country. And that is giving us an indication of where the spring market potentially is going to be. So as you can see, there's a significant difference between home prices across the country. Milwaukee is still very, very affordable, even though we feel that real estate has gotten expensive in the grand scheme of things. Looking on a national level, we are still very inexpensive. And when you live in a time where working remote is a real possibility, money is always flowing from high prices to low prices. And this, of course, will increase the migration trends within the US. Take, for example, the recent layoffs that we have seen in Silicon Valley. I think between Twitter and Facebook and a couple others, almost 20,000 people got laid off from really high-paying high-tech jobs, and many of them had a mortgage payment of $8,000, $10,000, which is completely absurd in our frame of reference here in Milwaukee. But they are now considering, okay, I've lost my job, so should I continue to make my $10,000 mortgage payment, or should I be moving to a part in the country and work from there remotely where housing is less expensive? Of course, when you hear information about layoffs in the news, then the question becomes, what can we expect in terms of a recession? That is a topic that we have in the news more and more. And here I have a survey from the Wall Street Journal, latest update. 63% of the economists think that we have a very good chance of a recession in the next 12 months. So this seems to become more and more eminent. And with that, the question becomes, what can we expect in Milwaukee from our real estate market if indeed we are going to face a recession? And in order to answer that question, let me take you back a little bit in history. I pulled here the data together for the Milwaukee housing market for the last 20 years. So this is data that I've never shown here before, but I think it's important to look at the big picture here. And I want to start out here in the year 2000. So you can see here on this axis, this is Milwaukee single family inventory. And we've always been right around 8,000 homes until 2004. We had a lot of new construction in those years. And that was, of course, fueled by super aggressive mortgage rates or mortgage policies. So everybody could get a loan. You didn't even have to show income or assets. You were just able to get a loan and get a house built no matter of your qualification. And we were cranking out houses not only in the rest of the US, but also here in Milwaukee a lot. And you can see inventory was rising. In 2005, we had already exceeded 10,000 homes. A lot of them started to be sitting vacant because there were just more houses flooding the market than we actually needed. We had more houses than people. And in the following year, 2006, that trend continued, and we almost hit 16,000 homes here in Milwaukee on the market. Now, compare this with about 8,000, which was normal before. So our inventory doubled. And then, of course, in 2007, the mortgage bubble popped, and then we know the recession of 2008 and 2009. So it was this what was ultimately causing the recession, and this was also driving down real estate prices here in the years to follow. And then we see prices going up here. But the important part here is when you look here where we are with inventory, we are so low as of October, 3,738 homes for sale in the Milwaukee area. Before home prices can come down, we need to have an exuberance of inventory. Otherwise, there is no reason for sellers. If there's an inventory shortage, sellers are not going to motivate to lower their prices. So that is the reason why I always look so much on inventory, because when you look at the big picture here over the last 20 years, you can see the correlation and how it played out. It's kind of funny how people were saying in 2008, nobody saw that coming. You only had to look at what inventory was doing in these 4 years and how it doubled from an already quite high level compared to where we are now. So for that reason, From an inventory point of view, we do not need to be concerned about pressure on the housing market. The other piece to look at is the job and employment market. And we have here the recession from 2008, and as you would expect for a time like this, you have very high unemployment rates. So that means a lot of people are looking for jobs and you have very few job openings. Then, of course, the pandemic hit and we had layoffs here, temporary layoffs, and then that came down again. And right now we have somewhat of an inverse situation. So I really have to say this slowly. We have 6 million people unemployed and we have almost 11 million open jobs. So almost twice as many open jobs than we have people unemployed. So that is really an interesting situation from a job market. Job market continues very strong. And that is really a hallmark of a recession. When you ask people why are they concerned about a recession, it's usually because they're worried about being laid off. So we are far away from layoffs. The job market is looking very robust here at the moment. A recession also does not mean falling home prices. So you've seen this chart before, but I wanted to bring it back because it is so important to understand this, that when we're in an economic recession, it does not automatically mean that home prices are coming down. In 1980, we have seen 6.1% home price increase during a recession. In 1981, 3.5% increase. A little bit of a loss here in 91. In 2001, home prices went up 6.6% during a recession. And the only outlier here is what we all remember, that's 2008. But that was not a recession that caused home prices to go down. That was a housing market situation, a mortgage crisis that actually caused a recession. So the cause and effect are inverted here. And the situation that we have today with housing inventory, as you've just seen, is really completely different than what we have seen back there. And in 2020, the short recession we had, home prices went up 6%. So if we go actually into a recession, there is very little hope if you're a buyer that home prices will come down in a meaningful way. Market is softening, but prices are not really coming down that much. But what it does mean is a recession usually means mortgage rates are coming down. You've seen this before as well, on average minus 1.8%. And we have just seen last Thursday the perfect example with the consumer price index that shows very well how this works. Is inflation data comes down and that has an impact on mortgage rates. So we will continue to keep an eye on what is going on with inflation. What are experts predicting for next year, for 2023, for home prices? So this is a very mixed bag, and I wanted to show you this. So you have some optimists and you have some pessimists when it comes to 2023. So it's going to be a little bit difficult, but we can actually make sense out of this because it depends where you focus on when you look at the national US housing market. If your focus is a lot more on new construction and on the East Coast and on the West Coast, then you're going to be more concerned about home price development in 2023 than when you're focused on other parts of the country. So the home price expectation survey is still plus 2.6% for next year. National Association of Realtors are still slightly optimistic with 1.2%. This is the Mortgage Banker Association, Freddie Mac, Fannie Mae, and then we have Wells Fargo. So Wells Fargo is here one of the most pessimistic ones for next year, but I also want to show you this. They're pessimistic for 2023, but in the same report, they also said they're optimistic for 2024 and they're predicting home prices to go up 3.1%. So it remains to be seen how this is going to be panning out, but keep in mind that we're talking here about the national market and not necessarily about the market here in Milwaukee. Here's another comparison that I wanted to show you between the Milwaukee market versus the national market. And there's a number of takeaways here. So first of all, you can see that every real estate market has a seasonality. It's just the seasonality here in Milwaukee is more pronounced. We have a stronger seasonality than we have on a national level. So normally from peak to trough, so from here in summer, May, June, usually maybe July, all the way through December, January, we usually see a 12 to 15% drop in home prices. This is why I always say, if you're buying and you have the liberty to choose the time of the year you want to buy, then choose a time of the year where home prices are softening. So we have a strong seasonality. At the moment, home prices have dropped about 10% so far in Milwaukee. So we are exactly where we would think we would be this time of the year. So if people are saying, well, home prices are dropping, they're comparing month over month. So what they're saying is that homes are cheaper now than they used to be in spring and summer, which is correct. We have to compare with what's happening last year in October, and we're still 7.7% ahead. The other thing to keep in mind here, and I think that's interesting, is that the national market has really accelerated a lot over the last years. In Milwaukee, we have been a lot more moderate with our home price increases. So this line is a lot more flat. And when you compare the national median home price in the US is now, it came down already a little bit, but it is still over $400,000. That is the national median. From East Coast to West Coast, that's what you have to budget for a median house. In Milwaukee, we feel that our home prices have gone up so much and that we're expensive, which from a Milwaukee perspective may be correct, but when you look at it on a national perspective, then homes are still very inexpensive here in Milwaukee. So what can we expect for the next weeks and months here in the Milwaukee area? First of all, the Milwaukee market will remain moderately competitive. It's not as crazy as it used to be in spring, where we had 10, 20 offers on every good listing and waiving inspections and waiving appraisals. But we are still seeing 1 or 2 or 3 offers. We had a couple listings here that we had listed that got multiple offers, and we're still seeing it across the marketplace. Even though it has softened, good listings will still going for a strong price. Supply remains to be short. Inventory is very likely to drop further. That is a combination of the typical seasonality. Sellers start to think, well, the holidays are coming and then it's winter, so might as well wait for spring. But sellers are also impacted by mortgage rates. So we have that combination of both things. This is why I think inventory will drop even further, and that makes our job as real estate agents even harder. People always think it's great to be a real estate agent when the market is very hot and competitive. And it's tough because if you have 20 offers on a property, that means 19 agents did not go home with an accepted offer. So that it's really a skill-based market. It is becoming very, very technical, and that is tough for young agents here. Demand remains very high. So you have heard it before. It's driven by a demographic shift. Millennials have aged into their home buying years, getting married, having babies, and of course they want to buy a home. Many clients that I speak with these days are telling me they're on pause because rates are so high and holidays are coming, so they want to wait for something better. But the question to ask here really is what will happen if mortgage rates are dropping? And I think a legitimate concern is that if we see rates dropping further, and if they go back into the low 6s or even into the high 5s, then a lot of these buyers that are currently on the sidelines and that are currently hitting the pause button will jump back into the market, and that would be a recipe for a hyper competitive spring market that will drive prices up, of course. So mortgage rates will definitely define the spring market. So we have to watch what's going on with inflation, what the Fed is going to do. That will drive rates, and that will ultimately decide what version of the spring market we're going to get. But if you believe that rates are coming down, you can always refinance at that point and take advantage of the slower market right now. And then when the market is going crazy because rates are low, you can just refinance at that point. And finally, I really want to hammer that point home. The local Milwaukee market will most likely continue to outperform the national market. Our prices are so low and we have such a good affordability that a lot of people from the coasts are looking for alternative places where they can work remotely. And when you have such a big price difference, money always flows from high to low. So we will see a lot more of that in the next years. All right. So with that, if you have plans for 2023, let's talk. Every situation is very different. It depends on what type of property you have now, what you are looking to accomplish, what your personal circumstances is. And we can get together on the phone or on a Zoom call and talk a little bit about your personal situation and come up with a strategy for 2023 that's right for you. Don't wait until the very last second to call me. The sooner you call me, the more I can help you on developing your strategy for 2023. You have my contact information here on the screen. You can send me an email, call me on my cell phone, or send me a text message, whatever works best for you. I'm looking forward to hearing from you. Thank you very much for watching, and I'll see you next month.